Our classroom stock portfolio now has an annual return of 20.89% and has grown to $1,979 after 120 weeks. Hi, Professor Rex here. We are now a little over 2 years into our class project where we invest a total of $12.50 per week and split it up to buy 10 different dividend-paying stocks. Our portfolio had a good week as companies continue to report their first quarter results. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week, or to the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, as I mentioned, the portfolio's value is over $1,979. The portfolio's return has been 20.89% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6, which also beat the S&P 500. And in the preceding year, the portfolio again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I include at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower and therefore better for dividend-paying stocks. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? Next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck, in other words, the equivalent of $12.50 per week. And because of my brokerage account, Fidelity allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase by at least the amount of inflation. By the way, I also invest in these same stocks in my portfolio, my retirement portfolio, and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, in this example, it's assumed that the person invested an additional 35 cents per week for a total of $12.09 per week instead of the original $11.74. For our classroom stock portfolio, In year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't quite as high, so we boosted the weekly investment by only 49 cents for a weekly investment of $13.81 per week. A very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our Classroom stock portfolio. As of today, our Classroom stock portfolio's value is $1,979. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's value would only be $1,682, a difference of 17.6%, which is higher than last week. Obviously, there is no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting into our Classroom stock portfolio stocks. I also prefer our actively managed Classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has, at times, had large positions in stocks that I consider to be value traps, which is not good. This slide shows our best performing stocks based on when they were initially purchased. Stocks in yellow have been sold. So it looks like Broadcom moved up to the number 2 spot behind only Lam Research, which is a total return of 146.5% in 19 months. The stock with the fastest rise so far is WK Kellogg, the cereal maker, with a total return of 108.4% in only 5.2 months. Also remember that total returns includes both the dividends the company has paid as well as an increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called dividend growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments we made so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing stocks this week, ranging from nearly 13% to 5%. We had so many stocks whose price increased by more than 5% this week that I had to split this up into 2 slides. So on the first slide, our best performers are Applied Materials, ASML, Atcor, Broadcom, Build-A-Bear, Crane, Carlisle Companies, Domino's Pizza, Goldman Sachs, and Hess Corporation. And here's our second slide of top performers this week. They included Intuit, the makers of TurboTax, Quicken, and QuickBooks, which I teach. ITT, KLA Tencor, which I call Clack. WK Kellogg, the cereal maker that we said was really hot. Lam Research, our best performer so far. Martin Marietta, the materials company. Berdosio Education, Skyworks, Thermo Fisher, and Tractor Supply. Before we look at the 10 stocks we bought this week, here are the 10 stocks we bought a year ago along with their total returns, which of course includes dividends. I still own all the stocks except the stocks in yellow. So I sold Williams-Sonoma because it appeared to be fairly valued, but so far it turns out I sold it way too soon because it's up 46% since I sold it. And that does not even include dividends. I sold Robert Half to generate additional funds to invest, and the company seemed to be closely fairly valued at the time. And I still think it is a hold or even a sell. I wouldn't buy Robert Half at this point. And I sold Fidelity National because they cut their dividend. This is usually a very bad sign, but we made a 28.5% profit in less than a year. The average return of the 10 stocks I bought a year ago is 37%, despite 2 stocks not being held the full year. The annualized return of all 10 stocks is 40%. Now, 90% of our portfolio is comprised of high-quality dividend growth stocks. In other words, these are companies that have a history of paying dividends for a long time, and they have a history of increasing those dividends year after year. But the other 10% of our investments in this portfolio is invested in under-the-radar dividend payers. These are usually very small stocks with little information and or a short track record. Therefore, they tend to be very volatile and very risky. No one should be purchasing these under-the-radar dividend payers until they have done their due diligence, which means do some research on the company. They are not for the faint of heart. Now, this week we bought an under-the-radar dividend payer. Here's a screenshot of it from Yahoo Finance. You may have heard of the company. It's called Google or Alphabet, whichever you prefer. This week, Google announced the company will pay their very first dividend this year. So I do call it an under-the-radar dividend payer because it's never paid dividends until now. Now let's talk about the other dividend-paying stocks we bought this week. Here are my ratings for the top 14 dividend-paying stocks this past week. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we do not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. This table includes their industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The two most undervalued stocks this week continue to be Comcast, Lithium Motors, and Air Products. Remember, all of these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy, something that you could use over the long run to live off of the dividends in your portfolio. On this slide, I want to show the components to my quality grade of those top 14 stocks. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in those smaller, usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. Now, all the stocks on this slide qualify as high quality and are dividend growth stocks. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings, also called profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest American Express, Microsoft, and Apple. The companies earning the highest financial health ratings are MasterCard, Visa, Microsoft, and Apple. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Interpublic and Skyworks with A+ ratings, followed by Comcast, Starbucks, and Bank of New York Mellon. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends in the future. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are American Express, MasterCard, and Apple. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, American Express, MasterCard, and Visa. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6%, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. On this slide, we are looking at stocks in our portfolio that have raised their dividends recently. 4 of our stocks this week announced they're increasing their dividends again. They are NASDAQ, Evercore, Lithium Motors, and Ameriprise. Ideally, we want our companies to raise their dividends higher than 3%, which is the historical average of inflation. The announced dividend increases this week average 7.5%. Nice. And here's a look at the 10 stocks that make up the largest portion of the portfolio as of Sunday. Charles Schwab is the largest holding at 4.4%, followed by American Express, Microsoft, Elysian, and Visa. New to the top 10 is cereal maker WK Kellogg, which has been our hottest stock lately, as I mentioned earlier. Its stock has more than doubled in the 5 months we've held it. It is one of those under-the-radar dividend payers, as he recently started paying a dividend. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if the company makes up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 90. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company. Once we download the company financial and accounting information in the spreadsheet, which we do at least weekly, and doesn't take that much time. So those are the companies we bought this week. We are trying other strategies too, using real stock portfolios. Besides this dividend growth strategy, we are running the following portfolios: a high yield dividend paying stocks portfolio. This high yield portfolio currently has a 4.5% yield and is surprisingly beating the S&P 500. I would have thought that a yield that high would not produce enough capital gains to beat the market, but so far it has. Let me know if you want any videos about that portfolio. It was started in August of last year, but the average investment in the portfolio has an annualized return of 39.1% versus 29.2% for the S&P 500. Obviously, those numbers will likely come down. We've also got a portfolio with stocks with the best competitive advantages, also called moats. Note that all stocks are eligible for that portfolio, both dividend-paying stocks and non-dividend-paying stocks. And finally, we start a technology-focused portfolio investing in these themes: artificial intelligence, big data, cloud computing, cybersecurity, and software as a service. This portfolio of tech stocks is up 11.28% this year versus a return of 3.99% for tech fund XLK. So we're trouncing that ETF so far. Who knows what's going to happen in the future? So in the comments, let me know if you have any questions or if you want to know more about the other portfolios. Also, let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me: YouTube, obviously, as well as Twitter/X, LinkedIn, and my website, beatthestockmarket.com. Have a great week.